Puts. I sold Alibaba puts. Chill. I didn't sell any Alibaba stock. I apologize in advance for this title, but I guess this was an experiment to test out how the algorithm functions. So anyway, in the name of transparency, I wanted to disclose the put position that I initiated sometime last week. So currently, due to the limited cash flow that I have on hand, because it probably wouldn't even be affecting my cost price by a lot, I sold a long-dated put option instead to increase my exposure to the underlying stock. So essentially, I'm borrowing against my future cash flow to secure this cash-covered put. First, I have a $70 strike BABA put expiring in January of 2023, where I received $617 for writing that put. Second, I sold two $80 strike price 9988 puts expiring in December of 2022, where I received 7,700 Hong Kong dollar for writing the two puts. If I were to convert everything to a common denominator, which is the United States dollar, I received 617 for writing the BABA put and 992 US dollar for the two 9988 puts. So on the aggregate, assuming that Alibaba really falls to $50 or something, because who knows what will happen next. Maybe China decides to pull a Russia. So my average cost of owning the BABA share would be around $64 per ADR share or 6.4 thousand for 100 BABA shares. And my average cost for the 9988 shares would be 72.25 Hong Kong dollars per share, which is $74 USD per ADR. Hence, causing my entire cash outlay to be 9.25 thousand USD. So in total, I would need around 15.65 thousand US dollar to cover my outstanding 3 put contracts. So before my broker starts getting jittery because they're scared that I will bail out, remember to smash the like button in hopes that I don't go bankrupt from this. So jokes aside, so these are all calculated based on my own financial situation and my own financial circumstance. So please don't do it just because I did it. So personally, I'm more than comfortable owning more Alibaba shares at the $60 to $70 price range, not barring any substantial change to the business in the coming 2 quarters. So if I were to do the calculations in the best case scenario, I will keep the premiums that I gain from writing the 3 put options, which total to about 1.6 thousand USD. So if it stays above $80 by the end of this year, I get to keep everything. So in the worst case scenario though, I will have to fork out 15.65 thousand to buy everything up and to continue becoming the #1 fan of Alibaba on YouTube, and of course, a part-time backholder too with you. So in this setup, if it works out, it will probably yield around 10.22% in a span of 10 to 11 months. Surely, there are no free lunches in the world, but I'm basically the insurance company for whoever that bought the put contract that I wrote. So if the worst case scenario do occur and I buy up all the underlying shares, I would probably average down my position to around sub $110. And that would be something that I'm excited to work with. And I'll be gladly a shareholder of Alibaba at $110 for the long term, of course. Now, comparatively speaking, my exposure in this stock will just keep increasing, and that is probably a risk that I'm comfortable and willing to take. But please do your own due diligence and invest accordingly, and don't just listen to all these so-called financial gurus or talking heads on YouTube. I cannot stress enough that the activity of picking stocks itself might not be suitable for everyone. And of course, to just stay invested, you can just buy a broad-based ETF. But still, watch my videos for entertainment purposes, in case I go broke and you get to document this entire journey thus far. So let me try to outline some of the key risks for considerations, especially during the timing of such long-dated puts. Number 1, since it has such a long timeline, the intrinsic value of the option makes up a majority of the price. Hence, I do look towards disposing this at the second half of the year if and only if it is severely out of the money and I wish to realize most of the option decay value. If not, I'll be happy to hold through it unless, like I disclosed previously, my thesis on the underlying business changed. But I highly doubt so because 2 quarters might not be a long enough time frame to convince me otherwise. Number 2, the US-China tension has definitely not dissipated. However, it has definitely taken a back burner in this current news cycle as everyone is busy with another world conflict. But let's not forget about HFCA, which is Holding Foreign Companies Accountable Act. Yes, the timeline is still ticking, and we have a time bomb which seeks to detonate by the end of next year. So, if a delisting event were to really happen, then we can kiss goodbye to the share prices of all these US-listed Chinese stocks. Number 3, 2022 is an election year for both China and the United States. For the US, it will be the midterms in November. For China, it will be the consolidation of power for Chairman Xi, concretizing his status of emperor for life. Sure, elections usually do introduce some form of volatility to the markets, but I believe the results of both are kind of expected, with Xi staying on in office, and on the other side of the globe, although it is 50-50, but in the past 40 years, the party controlling the White House has gained Senate seats in only 3 midterms: 2018, 2022, and 1982. So will President Biden be able to make the 4th one come true? We shall wait and see. If not, if history serves as a guide, the higher probability of a Democrat-controlled White House and a Republican-controlled Senate will result in a quote-unquote better check and balance and gridlock, for lack of a better word. So in any case though, I think selling puts at a much lower strike allows you to have more propensity and more bandwidth to dictate the price that you are comfortable with averaging down. But this also means that you have the obligation to get in despite any forms of thesis changing events that happen and any subsequent black swan events that will leave you just sucking a thumb with no other recourse. Especially so when you're playing with such long dated options with such a long timeline. So clearly, if you're to bite off more than you can chew, and take myself for example, if I decide to sell 10 puts instead, and this would bring my entire exposure up to 60,000 USD in order for me to ensure that it's cash secured. So although the premiums look delicious because I'm paid 6,000 upfront, but you should always keep in mind what is your maximum downside and what if you are really caught in that specific options trade. So are you willing, and more importantly, are you able to fulfill those obligations? So I know of certain fanciful strategies like whaling, which essentially tells you to sell put and if exercise, sell calls on them and then rinse and repeat this entire cycle. Bottom line though, I know there are many trade setups out there for options. But lesson 1 is to always manage your downside risk. So there is definitely this elusive promise of being able to survive purely on the premiums being paid to you by selling put options, especially on big dollar value stock like Tesla or Google for example. So a 2023 put option on Tesla with a strike of 900 will give you 22.2 thousand USD worth of premiums. 22.2 thousand. And that is probably equivalent to someone's annual pay on the other side of the globe. Sounds good, right? But don't forget, if there really comes the day when you need to buy the underlying stock, you need to shell out 67.7k on top of the 22.2k premiums that you receive for writing the initial contract. Sure, the yield looks amazing at a whopping 32% because it is a in-the-money put contract. Issue is, are you confident enough and prepared enough to do it? Despite how strong your conviction is, the market can and will always turn against you, and you have to be ready to take it. I know, at least for myself, I can't and won't be able to bring this 67,000 to the table by the end of this year, so this is out of the question for me about selling Tesla puts. Then, there will definitely be people commenting about rolling them out to a future date to a cheaper strike and essentially roll until it's gone. So in theory, everything sounds nice and dandy. I think everything works out perfectly, but on a company like Alibaba, if people started rolling this from $200, if they were to roll it until today, I think it's still not gone. So I'm prepared for the worst, and that should be the mindset going into options trading as well. Whether I sell covered calls on this or not, that will be a video for another day. So with that, do leave in the comment section down below. What are you doing with your Alibaba shares? Have you sold? Are you accumulating? Or are you fooling around with the options trades? So I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!